free banking people say, we trust a market process of profit and loss and entrepreneurship and contract enforcement to work all that out, just like we do in the provision of any other product. And yeah, are there special things about money? Yeah, but it's not special enough to where we need the government to either intervene or oversee this, or in the case of like the most extreme people, and I think Eichengreen maybe falls in this column, they say that money's so special that the government has to provide the money and then make the ultimate determination about the supply. And this, of course, happens through central banking and all the regulations that are promulgated. And I see a lot of this blowback to stablecoins as the central bankers and their apologists and maybe the academics, they're scared of, freedom is coming back, competition, a market process of discovering maybe different ways and more efficient ways to have money issued and paid and work around some of the older inefficient mechanisms. So it's an exciting thing if you're for innovation and free market and financial freedom.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I'm speaking with Tyler Watts. You may remember he was recently on this podcast talking about his proposal for letting people opt out of Social Security. But today the topic is related to the Genius Act. So I'm continuing the streak here at the InFi podcast of just talking about nothing but the Genius Act. But this is really more about economic history and what's known as the era of free banking in the United States that prevailed before the Civil War. And specifically, the news hook is that this economist, Barry Eichengreen, had written an op-ed in the New York Times lamenting the Genius Act. This was before it passed, but it was when the passage was imminent, and saying how stablecoins basically give private institutions the ability to create money. This is reminiscent of the wildcat free banking era in the United States before the Civil War, and look at all the bad things that happened back then. So largely what Tyler and I are doing in this discussion is spelling out what that institutional framework really was back in the so-called free banking era. And as you can guess, it was not as scary and as bad as the interventionist economists would have you believe. Just to round out, so Tyler is a PhD in economics from George Mason University. He also, as an undergrad, went to Hillsdale. That's how I knew of him. And he is currently professor at Ferris State University in the College of Business. So without further ado, here is my discussion with Tyler Watts, giving you an economic history lesson on how did free banking work in the United States. Well, Tyler, welcome back to the InFi podcast.
Great to be with you again, Bob.
So folks, we are still lightly talking about the Genius Act in this episode. I'm just continuing the streak, but the specific application is we are responding, Tyler and I, to a recent op-ed in the New York Times that came across my desk from economist Barry Eichengreen, who is professor of economics and political science at UC Berkeley. This was back on June 17th, actually. And the title the Times gave to his op-ed was, "The Genius Act Will Bring Economic Chaos." So that's officially what we're responding to, but largely what we're going to end up talking about in this episode is what the so-called free banking era, particularly in the United States, and we'll see the relevance to that. So let me just read a little bit of this, Tyler, to get us going. And Eichengreen starts out saying, "The growing value of cryptocurrency is resurrecting one of the most notorious features of the Wild West. Just as stagecoach drivers of the 19th century were ambushed by gold-seeking, gun-toting bandits, crypto holders and their families are increasingly finding themselves victims of violent kidnappings." All right. So just even on that point, I want to stress, and we'll put it in the links in the show notes page, folks. There's an article that's famous among libertarian-minded economists called "The Not So Wild Wild West." And it goes through and just shows like this image we have of the lawlessness of the West. And, it was just a bunch of bandits and hired guns and things like that. And that's why you need the respectable rule of law coming in from the state and government officials is largely misplaced. And I forget which guy it was, but one of the authors gave a talk at Texas Tech when I was there. And he opened up, it was a great way to just get everyone's attention and open up the talk, because he was saying, show of hands, how many bank robberies do you think there were in this Western state? I forget which one he was using between these two periods. And he was like giving options, and then people's hands were going down as he was lowering the number. And it turned out to be some ridiculously low number over the course of years. And his explanation was, well, yeah, back in like a Western town, somebody on their horse is holding up the bank. How are they going to get out of town without getting shot? Like if everybody's armed, you know what I mean? So his point was this image we have in the movies where the bandits come and they rob the bank and then just saunter out of town. And, the people are, oh no, until like the hero shows up, Liberty Valance or something, or the guy who stands up to Liberty Valance, I should say. But anyway, he was just explaining that this is crazy. If you just think about it for 2 seconds, this doesn't make any sense. Because everybody knows lots of people had guns back in this so-called lawless era. And so among other things, holding up the saloon or the local bank and then riding out of town, it would be a very risky thing to do. So anyway, there's that element. But Barry then, Eichengreen transitions and saying if Donald Trump and his allies get their way, we're going to have personal bankruptcies and financial instability. And then here's the money paragraph. What would unleash this chaos is a piece of legislation known as the Genius Act. In its effort to give crypto a patent of governmental authority and legitimacy, the Genius Act would give hundreds, perhaps even thousands of American companies the ability to issue their own currencies. Imagine Walmart issuing a Walmart coin and Amazon doing the same thing with an Amazon coin, enabling them to bypass the banking system and credit card networks. And then later, I'll just read one more. He says, this proposal bears an uncanny resemblance to the way America's monetary system functioned from the mid-1830s until the Civil War, a period known as the free banking era. So first, Tyler, I think just to make sure the listeners aren't getting mixed up, how did you feel? I disagree with the way he framed that. I think it's misleading to say, oh, this would allow private companies to issue their own currencies.
Well, I think my comment, I've got a printout here and I was feverishly kind of scrawling my heated response. And my comment was, yeah, exactly. And I actually said, this is correct. I think in banking or monetary, parlance, it's correct to say that's a form of currency. A more technical term maybe would be fiduciary media. But yeah, you could call it a currency. It's a means of paying the monetary asset, essentially, from one person to another.
Oh, sorry.
Can I privately?
Can I stop you? Because that sort of blew up in my face rhetorically. No, what I mean, though, is I think people might assume that he's saying, oh, so Americans, they could use dollars or they could use Walmart's money or Amazon's money. And I'm saying, in the free banking era, I'm fine saying banks issued money or currency, like in the form of banknotes, but they were still part of the M1 US dollar monetary stock.
Right, it's part of the dollar. So the
it's not like
currency
saying,
technically is correct, but it's not a new kind of money. And in my article, which is coming out on Econ Blog, hopefully next week, I said it's not a new money. It's just a new means. It's a new technology, and it's an exciting new technology of paying people that money, which presumably will be way more efficient and convenient for certain kinds of people. So yeah, the currency is a technical term that's correct, but you're right. It's not some kind of new kind of money. It's not a Bitcoin. Yeah. It's still US dollar.
Right. Here's the way.
Fully within the dollar.
Right. Here's what I'm trying to say.
Yep.
The only way to make his statement correct, and again, there's a way in which it is correct, but then by the same token, you could say, oh, right now we have Bank of America, whatever unit, and Citibank unit, and among the US dollars issued by the Federal Reserve. And I'm saying, yeah, there is a sense in which that's true, but people right now don't think that, Bank of America issues its own type of money and Citibank issues its own type of money, even though that is true in terms of what Eichengreen is saying in regard to stablecoin issuers.
Yeah, and certainly we can get into that, the kind of the mechanics of how that works. But when I read that paragraph, I said, that got me excited. Amazon issuing an Amazon coin. I said, Amazon gives me low prices and free shipping on everything, and they're really reliable. So yeah, that's what stablecoins do. They give you a lower price, so to speak, or a lower cost of using that resource. And they do it in a more because they have economies of scale and networks and things. And so they do it more efficiently and more probably reliably than the existing system. So that's what gets stablecoin people excited about this. And it's funny because he's trying to use that as a scare tactic. Oh no, big corporations are going to enter this space.
Right.
And it's going to destabilize it. No, it's going to bring efficiency. So right off the bat here, we're still on page 1 and he's just tripping all over himself, I'd say.
Right. And again, just the last thing, I know you get this, Tyler, to make sure that the audience isn't missing the distinction I was trying to make. And I think you're right. He's making it sound like they're doing something like how Bitcoin is not the same thing as the US dollar, or even among government fiat currencies. The euro is different from the dollar. And I'm saying, no, that's not what we're talking about here. It's not that Amazon is issuing its own fiat currency that might trade alongside the dollar. Just like you're saying with Amazon, if you buy an iPhone and from somebody, they ship it via Amazon, it's not that, oh, it's an Amazon phone. It's just saying, no, it's the thing that you wanted. It's just Amazon's giving it to you, like you said, at a low price. So yeah, if you want US dollars as the money you're using, you can do it via stablecoins issued by these companies, and it'll be on better terms, presumably, or at least that is a possibility. That's why you might use it from them as opposed to using it from Citibank. But in all cases, we're talking about US dollars, and different companies are coming up with different ways to give you access to that.
Exactly right. Yep.
Okay, so here, let me just read a little bit more of why he liked the free banking era. So he said, at the time, Americans were deeply suspicious of elites and of concentrated financial power. In 1832, talks about Andrew Jackson, vetoing the renewal of the Second Bank of the United States. But because he did that, now Americans were woefully, didn't have banking services. And so then Eichengreen continues, over the next few decades, about half the states passed laws that allowed any people with a minimum amount of their own funds to open a bank. Similar to what's being proposed by the Genius Act, all banks were entitled to issue their own dollars. So there again, they're issuing dollars. It's not that they're issuing some new form of currency, some unit of money, as long as they held $1 of collateral for every $1 issued. Sometimes it worked, but other times it didn't. Sometimes those assets were all but worthless, resulting in panics and bank runs, and residents of states like Michigan, where regulation was lax, found themselves holding the bag. One estimate places the loss to their residents as high as $4 million, which was half of their income as of 1840. And then last thing I'll say here is we had 18 states with 18 different regulatory systems, resulted in different banks issuing different banknotes, all trading at different prices. That created confusion since the recipient of a dollar could not always be sure what it was worth. And so he just continues in that vein. So his point is, the whole point of everyone using the same currency is that we know what it is when you're paying somebody. You know what you don't want to have people, merchants having to inspect banknotes and trying to figure out, well, which bank issued this thing, and maybe we'll give you, we'll treat this one at 92 cents to the official face dollar and this other one at 87 cents because they're not as safe. And that's just chaos. People don't even know how much they have to turn over to get the product they want to buy. And so let's just not go down this crazy path that's going to lead to all sorts of instability, just like happened during the so-called free banking era. So I'll stop there. Tyler, how do you want to take this discussion?
So there's a little bit of truth in here, but a lot of it's just like straw manning and glossing over important details. And it's a really kind of stifled viewpoint, I'd say, as to how the system actually worked. So I don't know if we should maybe start off kind of just by explaining how free banking works, and then we can critique.
I think so.
Kind of flawed view, maybe. So, and when I teach this, I talk about free banking in theory and then free banking in practice. And there's kind of a theoretical ideal that was probably best laid out by George Selgin. I think the book is called The Theory of Free Banking. By the way, Bob, just a side note that you might find interesting. That's the book that kind of turned me more from the Rothbardian view of money and banking towards the free banking view, for what it's worth. So I know you might be kind of on the other side of that, but you've always been very civil and open about this debate, and I greatly appreciate that because I know you're a truth seeker at heart. So with tons of respect there.
So thanks. Why don't we just to make sure the listeners don't get mixed up? So folks, number one, Tyler and I are agreeing that yes, the stablecoin issuance and what the Genius Act is proposing, that is very analogous to free banking. So we're not disagreeing with you, but our point is that's a good thing because free banking is cool. Like that's good for consumers. It's good for the monetary system and whatnot. And then, what Tyler's referring to, folks, is in the literature among academic economists about free banking, there is a dispute among some about is what's called fractional reserve banking. Is that a good practice so long as it's not aided and abetted by government subsidies and whatnot? Like if it's just a market outcome, is that good or bad? And economists disagree about that. And so, yes, one of the pioneers and authorities on this subject is this guy, George Selgin. I actually debated him at the Soho Forum on this narrow question of totally free market among privately produced banks and, without government picking winners and losers and whatnot. What would be like the equilibrium reserve ratio and stuff like that? And does that cause the boom bust cycle? So we argue about those types of things. But yes, in terms of big picture, we're all on the same page. We don't want a central bank. We don't want micromanagement regulations from the government and so on. Just the same regulatory framework that the government applies to pizza places, apply that to banks, for example. Just have contract enforcement. And then what results would be a lot more stable, we claim, than the current system. So that's kind of the background here. And also, Tyler, George has been a guest frequently on this podcast as well.
Yeah, and that's great. You got a good array of different kind of, I would say, market-oriented perspectives on here. So anyway, in free banking, in theory, you have free entry into banking, maybe with some very minimal regulations. You have to demonstrate that you have the capital, but otherwise, anybody with capital who wants to risk it and try to go into banking can go into banking, just like any other business. You all want to go and be a home builder. Okay, if you can get the tools you need and maybe a building license or whatever, it's just some minimal regulations, go and try it. And then the market will determine whether you succeed or fail. Now, what do banks do? They take deposits and they make loans. The free bank does that. It borrows money from the customers who deposit. And I don't know if you want to get into the kind of technical details of demand versus time deposits and all of that, but basically banks borrow money from their depositors and then intermediate those funds into loans to supply businesses and other consumers with capital, with money they need to make investments or to make large purchases. So that's all hopefully pretty obvious. That's pretty intuitive. I think we know what banks do. But the issue with free banking is that banks have the total freedom to form and to operate in terms of the nature of their liabilities. And so this is where this is kind of the crutch where banks can issue banknotes. I'll talk about that here in a second. And then, of course, their assets. What are they free to invest in? What kind of loans they can make? What kind of securities they can hold? How much money they need to hold in reserve against their liabilities, and so on. So in today's system, banks take in deposits, checking accounts, demand deposits, and then savings accounts, time deposits. Those are the liabilities. And then they can make a lot of different kinds of loans, but there are restrictions on what else they can invest in. In the United States, banks can't really invest in securities like corporate stocks or bonds. They can hold government bonds, but they can't issue currency. In free banking, kind of the hallmark and the big distinguishing feature, I'd say, between free banking and what we have today is that in free banking, banks could also issue currency. Now, what is currency? Currency, banknotes, is a piece of paper. Well, historically, it was a piece of paper that was if it's reliable, it becomes consistent with money, but it's technically not money. Because what is money? In free banking in the mid-1800s, that was a gold coin. And that was the ultimate kind of legal standard defined unit of money. And that we'll call that base money or reserves to distinguish it from the money, or technically speaking, money substitutes or money claims. Part of the problem here is there's a lot of terminology, a lot of jargon you have to get a handle on. So we've got base money, that's gold and silver historically. Today, it would just be money issued by the Federal Reserve, also known as reserves. And then that's also known as outside money, because that money exists and is created and kind of regulated outside the banking system, technically speaking. Then there's inside money, which is created or issued or recorded inside the banking system. Banknotes, currency, fiduciary media, money substitutes. So they're all kind of, for our purposes, so those are probably interchangeable terms.
I see Ludwig von Mises looking over your shoulder, and he's glad you're using his taxonomy. So,
well, that was one thing Mises was good at. He was very careful about defining terms clearly. So banks can issue that currency, banknotes, which is just a promise to pay units of the ultimate form of money, the base money. So gold coins. So what's the reason for that? Well, I think there's at least two. There's one kind of obvious one, and maybe not so obvious, but also pertinent one. If we're dealing in a large transaction, a large value transaction, thousands of dollars, that would be a hefty bag of gold coins that I'm carrying around, and it's jingling in my pockets, and I always kind of joke with my students. I walk out of the bank with a big canvas bag with the dollar sign on it. It's full of gold coins. It's kind of slowing me down. I become a target for maybe thieves or robbers. And it's just not convenient to move gold coins or silver coins around, especially in large volumes like that, because I'm going to take it from my bank. I'm buying a house from you, let's say. It's $100,000. I'm going to give you a huge sack of gold coins. And then what are you going to do? You're just going to take it and put it in your bank. Well, why don't we just have the bank transfer the money from my bank account to your bank account? Of course, that's what a check does. But what if you don't have a checking account? I need to pay you, but I still want to avoid the inconvenience of lugging bags of gold coin around. Well, the bank can issue a note, which is kind of like a check, but it's payable to the bearer, who, in other words, whoever's holding it, rather than whoever is the specific endorsee on the check. So, and I was just looking at some history. A scholar I know out of Arizona State, Jonathan Barth, does some great stuff on this. The first banknotes that kind of in the modern form go back to, I think, the 1600s in this form, and they're a direct kind of evolution from checks. So I could write you a check, but then you say, well, I want to actually just spend this money. I don't need to deposit it in my bank because I have some bills I need to pay. And in the early days, you could maybe endorse my check over to the person you wanted to pay, and then he could scratch out your name and write somebody else's name. Well, eventually banks realized that, hey, let's just write, this is payable to the bearer. Then it can become its own form of money that circulates as long as people are willing to trust the promise of the bank that issued it to pay out that fundamental money, the gold coin back in the old days, or today it would be Federal Reserve currency ultimately. So that's the difference. Now, people get all worked up about that because they say, well, banks will just issue more currency, more banknotes, than they have money in their vaults to pay out.
Can I stop you, Tyler?
Against it.
Because this is critical. I just want to make sure everyone's tracking with you up to now. So again, back in this period of the so-called free banking era, again, the underlying money, the way Americans thought of commerce and what is my income denominated? Oh, how much does that stagecoach cost or whatever, was dollars. That's how they thought. And officially, in terms of the federal government's definition and what was lawful money and what was like for the satisfaction of, debts and whatnot, they defined dollar, like a certain amount of weight of grams of gold or silver to like a $10 gold eagle coin. And they specified how many grams of gold went into that, right? And so that was the official money. And that's something I want to stress. The U.S. government, folks, did not print currency before the Civil War, okay? During the Civil War, they did what was called the greenbacks. It was an infamous thing where, as the name suggests, it was green pieces of paper. But before that, no, the official money were gold and silver coins. And then as Tyler's saying, for reasons of convenience and whatnot, that, in many applications, you wouldn't want to be carrying around actual coins. And so the banks issued pieces of paper. But again, it was not, they were counterfeit. They had anti-counterfeit measures. Like it was hard to fake a banknote because obviously the banks wouldn't want people going around passing fake bills or notes that look like it was theirs. And so they put in, all sorts of things to make it hard to counterfeit. But again, it was not that the Smith Bank issuing its notes that they were units of Smiths or something, or units of aardvarks. It was US dollars. But again, the point was, it was saying the bearer of this note can go to any branch of the Smith Bank and turn it in and get whatever, $1 in silver coins if they want. Or
that's right. The best way to think about banknotes, it's a promise to pay money.
Yes.
And the ultimate form of money, gold dollars. I had a gold dollar somewhere around here. It's tiny little coins, 24.75 grains of gold, or silver, because we had bimetallism up until 1873, I guess. So yeah, it's a promise to pay money. But the curious thing about it, and I think this is the source of a lot of the consternation, and even among kind of like pro-market people, there's some disagreements and debates, which is fun, is that if that bank's promise is trusted and that bank is viewed as reliable, that promise to pay the money can circulate on its own because it's as good as money,
right?
Up to the extent that the bank is trustworthy and is known to be able to redeem it. So basically, the circulation of banknotes takes off once people understand that, oh, the bank is good for this. I don't need to bother with going to the bank, turning in the note, and getting the gold coins. And so that the argument I was getting at, the convenience purpose, is going to be one of the big arguments there. It lowers the transactions costs of using money. They used to call it folding money. I can fold up and put a lot of money in my wallet.
Right.
And you don't even need to know that I have $100,000 on me versus, carrying a clunky sack of gold coins around. So there's kind of a convenience rationale for it. There's a security rationale. But then there's from the bank's perspective, and this is, I think, the trickier thing. The bank realizes that it's way more convenient, or it's way more beneficial for a bank to, quote, fund its credit creation by issuing banknotes rather than by just handing people gold out of the vaults. Because to the extent that those notes will circulate as a substitute form of money, and I think that's one of Mises's terms, right? It's a money substitute. Well, then they can increase the volume of their lending within certain limits. And I don't know if we want to get into the kind of the nitty-gritty details of the clearing mechanism and the law of reflux and all that stuff, the regulatory aspect of this, but banks can issue some additional credit and then they can profit from what's called float, because bank notes enter circulation largely from the bank's lending activities. So if I'm a bank and I lend you $10,000 and I fund that loan by giving you $10,000 in Bank of Watts notes, and let's say you're paying 5% interest on the loan, up until those notes come back to be redeemed in gold coin, I'm going to earn a 5% interest kind of for free. Now, eventually, those you're going to use those notes, and the recipients of those notes are going to deposit them in their own banks. And then those banks are going to send them to me and say, hey, we want the gold coin because we want to increase our reserves. We don't want to just be a repository for Bank of Watts notes. We want gold so we can increase our own lending. So this interbank mechanism of clearing the notes, or maybe occasionally some people will just walk up to my bank counter and put the notes down and say, give us the gold coin. So it's not going to be kind of some kind of indefinite process where I can just keep pumping out notes into circulation and earn money indefinitely. Now that's what in Eichengreen, and we can get into this, Eichengreen is pointing to this concept or this phenomenon of wildcat banking. And that is what wildcat banks tried to do. But that's not what prevails in a sound free banking system, because that in a sound free banking system, the banks have to pay out the gold or silver, whatever the underlying money is, when those bank liabilities are presented for redemption. And there's a beautiful, and I'll refer the viewers to George Selgin or other people you can study that mechanism. It's called the law of reflux, and then the clearing mechanism. And if a bank has adverse clearings, meaning they issued more liabilities, banknotes or other liabilities than they have liabilities of other banks, they're going to have a gold drain, and that's going to be the corrective mechanism, which keeps that credit expansion via the note issuance. That's what's going to keep a lid on it. Now, of course, that's the subject of the debate between the full free bank pro fractional reserves people and the full reserves people. So I don't know. I'm happy to get into that, but I don't want to bog this down too much. Well, let me set that aside, because I think you and I are both big fans of stablecoins, maybe for some similar reasons and then maybe some slightly different reasons. But what I want to get at with Eichengreen is that he's painting free banking as it's very unstable, and it's characterized by wildcat banks. It's characterized by banks just willy-nilly flooding the market with currency and banknotes, and then the value of those collapses because they're not really backed up in assets like gold coin reserves or even other kinds of securities that are maybe stable value. And that's just, there were some episodes of that, but it's not emblematic of how the system worked in the United States. And also,
can I, Tyler, let me just, to the extent for the listeners right now that I think we should let me just spend like 2 minutes on the mechanism, because you're right. When they first hear the system we expounded earlier, that banks just issue these pieces of paper that say you're right, that someone might just think, well, that's crazy. Like, wouldn't just every bank just start willy-nilly printing these things up? And the reason, again, that's not a stable equilibrium, that in general, like picture, if there's 10 banks that kind of control the market, they each have 10% share of the market. Like, in other words, take the population and everybody has his or her own bank that they use. And so they start, when they want to get a loan or something, that they get notes from that particular bank. And so the point is, let's say the banks all originally have 100% reserves. And then if one bank expands more aggressively than the others, so like it starts lending out, it prints more notes than it has gold in the vault. Like, let's say it prints 50%. So now the people who borrow from that bank are going to have more pieces of paper per capita than the other ones. So just during normal commerce, they're going to spend more notes than the other bank's customers are going to spend of those banks' notes. And so at the end of every week or whatever, when the banks all settle up with each other, even if all the merchants take every bank's note at par, right? So this system doesn't require the merchants to be discriminating. They can all just sell goods and say, oh yeah, it's from a bank I've heard of. I'll take that at par. That's fine. The ultimate check to keep banks relatively honest and so that one bank's not more aggressive than its peers is, like Tyler's saying, they call it the law of reflux, different terms for it. But at the end of every period, the banks settle up with each other, right? So one rival bank is not just going to have notes piling up saying, my rival, if I turn these into my rival, I could get gold coins and just keep piling up those notes. No, they compare at the end of each week or end of month or whatever. And a lot of it's just canceling out transaction, right? If one has 100 claims on the other one saying you owe me 1,000 ounces of gold, and the other one has 998 claims, boom, it's just a net 2. And then the bank that's short takes 2 ounces of gold out of its vault and sends it over to the other bank. And they just do that periodically. So the point being, if one bank is really aggressive and has a much lower reserve ratio than the peers, its gold reserves will tend to flow out of the vault. And then ultimately the public will stop trusting that. Because what kills it is if somebody shows up and says, this thing says I have the legal right upon demand to get gold coins, and the bank says, oh, sorry, we don't have it right now, come back on Tuesday, then that bank's done. Then that word spreads quickly. So the system only works. The banks can only get away with inflating, if that's the word you want to use, and printing more notes than they have in reserve in the vault, if the public thinks these are interchangeable. That's what makes them money substitutes. And so that's the mechanism. And then, yes, different economists argue about just letting that ride and having no explicit government regulations on the reserve ratios, what would happen. That's kind of the issue, but that's the framework. And that's just like with home builders. You made that analogy, Tyler. It's not like if the government needs to pass regulations saying every house has to have a certain number of windows or a roof, because otherwise it'll rain. And imagine you spend $200,000 buying a house and there's no roof and it just gets soaked. That's crazy. It's like, well, that's stupid. You don't need a regulation for that. They would go out of business in 2 days.
Exactly.
Right? So that's kind of what we're arguing about here. So so I think that's enough just for the listener. I'm glad you brought that up because I might be skipping over some things. I do have a video, and maybe we can link it in my monetary economics course. Mm-hmm. That's a very detailed, like almost tedious explanation with a little model with 3 banks. And I've got the T accounts, and I show the clearing if they clear the liabilities against each other directly. And then if they go through a clearinghouse, and now that they have net settlement, and then the clearinghouse will kind of become the ultimate regulator. This is actually, by the way, what happened in the United States with the Suffolk system in Boston in the 1840s and 50s. So we could kind of get into the technical details of that, but your explanation is exactly correct. So there's a market mechanism that kind of, let's say, regulates or controls the issuance of bank issued money, notes, and that works well if it's a free market. Now, the other thing I wanted to say about free banking in the United States is it wasn't really free banking. At best, it's kind of quasi-free banking or stilted free banking, because the one element where people are free to start a bank is there, but that's severely limited. The famous flaw is that banks can't branch. So they can't diversify their deposit base or the risks of their loan portfolio geographically, which is that's a fatal flaw in American banking, actually, all the way up well into the 20th century. So we have the limitation of branching. And if you get into the free banking, or just let's say banking and monetary history of the United States literature at all, that'll be one of the first big things you see. Mm-hmm. So we had this huge flaw. How did that work? Was it just saying you couldn't cross state lines? Was that generally what we mean when we say that?
Well, okay, so my understanding is that there was no interstate branching. There was actually no interstate branching, I think, until like the late 1980s, early 1990s, technically.
Because I know that's a big reason free market economists point to as to why in the Great Depression, so many U.S. banks went down, whereas in Canada, it wasn't
Canada
nearly.
Had nationwide branching from the beginning, very stable, because they had that makes the bank much stronger, because it's not subject to if the local economy in my town tanks, my bank that only has a branch in my town, so all the depositors are from my town, and then all the borrowers are from my town. And I'm in Michigan here, so let's say this is pretty common, small towns in Michigan. A lot of them are auto suppliers. So if the auto industry tanks, that bank's depositors are auto workers. That bank's customers are small factories that make auto parts. Well, those factories who've borrowed money from the bank, they can't pay back their loans. And those workers are auto workers who might get laid off. They need to start withdrawing money.
Right.
So that makes that bank extremely fragile. Whereas if it could branch even statewide, and it could be involved in lending to some other industries, and it could broaden its deposit base to the whole state. If it could branch nationally, makes it even safer. So the lack of branching is a huge deal. And that made U.S. banks fragile in free banking, and then afterwards in the national banking system all the way up, even in the 1930s in particular, but even past that. So there's that issue. And then there's this issue of the security requirements. And this can maybe bring us back to stablecoins, because I think the stablecoin fears are baseless when you think about the security requirements. We could talk about whether they're going to be enforced or not. But in free banking in the United States, which by the way, free banking in the United States technically goes from the first laws are passed, I believe, in 1837. And the system was kind of killed by the imposition of the national banking system in 1863. So, although I think we've suspended the specie payments were suspended, I believe, in 1861 with the start of the Civil War. So you could maybe say up until 1861. So states required banks to secure and otherwise have collateral against their note issues, usually in the form of state government bonds. So the idea was, if this bank can't make good on its claims, on its redemption claims against its banknotes, the people who hold those notes will report that to the state bank regulator. The state bank regulator will shut down that bank and then sell off all the government bonds it deposited as security. And usually it was either a 1-to-1 ratio, or in some cases even more than 1-to-1. So, for example, to issue $90 in banknotes, you had to deposit $100 worth of government bonds. So that adds a margin of safety. It's over collateralized. And the government can sell those bonds off, get actual money, and then pay that out to the note holders, and everybody will be fine. So the problem, and that's maybe good in theory, and that was the basis of the national banking system too. National banking system just nationalized that for the entire country, and it kind of squashed these state free banks out of business. But the idea of that security may be sound in practice, but if you allow people to post securities of dubious value, and if I maybe get into this literature a little bit, we can see that this was almost the entire cause behind some of these free bank failures. The securities that they deposited as collateral were either like worthless or fraudulent or just undervalued. And so that was the reason why some banks were able to, quote, get away with kind of issuing more money than they could ultimately redeem. There were some problems with the regulation behind the securities. And those were actually kind of tweaked as free banking went along, and it became pretty stable and functional after some early hiccups, let's say. But these wildcat banks that Eichengreen talks about.
Can I just stop you? Let me just make a clarification here, just to make sure people are tracked. Because I know you've got some great quotes from these economic historians and some data to present, but I just want to make sure people understand the framework. So when we talk about, strictly speaking, I think sometimes there's a misnomer here when we say reserves, that in the standard literature, like among experts of, the economic theorists talking about banking, reserves mean the base money is in the vault, right? So that, like, if gold coins are the actual money, then yeah, somebody goes and gives $10 in gold coins in the vault, and then they get a note saying the bearer of this can get $10 at any branch. For 100% reserves, it would mean there's that $10 of gold is still sitting in the vault in the bank. To say there's like 50% reserves means the bank could take $5 of the gold and go do something else with it. So now what Tyler is saying is the states chartering these banks in the so-called free banking era, they didn't insist on, you got to keep actual gold coin in the vault fully backing up all your notes. Because for one thing, the bank would say, well, how am I going to make money doing that? I would have to charge my customers a fee for the service of providing vaults.
I call that a money warehouse, not a bank.
Right. Yeah. So it's like when you check your coat at a restaurant and they give you a ticket, they're not putting your coat to work by lending it out to homeless guys and then, earning an arbitrage. Like this is, no, we're storing it for you. And so that's like 100% backed, reserved, genuinely in the way economists use those terms, checking account services. That's, and that might exist as a thing. Okay. But then you would have to pay a fee for that service the bank's providing for you. So what people typically think of as, the bank's earning a spread or something and then passing some interest along to the depositor. the way that model works is, the bank takes the deposits and does something with them. And so when we say like there's, a 10% reserve requirement, it means that's the base money, like what people think they can turn the note in to redeem it for upon demand. That's what the reserve percentage refers to. And then, but then given that the bank is going to be legally allowed to do stuff with the excess, some stuff is riskier than others. They might, if they could just do whatever they want to earn the highest rate of return, some of that might be fairly risky. And so if the regulators want to say, no, we don't want the public to be turning over their gold coins and silver coins, getting pieces of paper, and then the banks can go invest in highly speculative assets. So instead, and also the governments have a vested interest in ensuring that they get the loans. They say, oh, I know. How about you lend the money to us and you take state bonds? And that's the collateral that goes in there. So again, like right now, the Genius Act, people are saying it's just 100% reserves. And I've been kind of lightly saying, guys, technically that's misleading because treasuries are not the same thing as money. Right.
That's true. Anyway. And also, this is an interesting thing. Mm-hmm. Bank deposits are also valid collateral for stablecoins.
Right.
And bank deposits, but today have a 0% reserve requirement.
Right. So it's funny.
There's a way what's one question with stablecoins is like, well, what's the leverage for banks? What's the way for this to be an intermediation vehicle if it's 100% reserves? Well, the reserves themselves are either securities or bank liability. So there's still, I think, plenty of room for like intermediation and financial play, let's say, with stablecoins. Yeah.
So the last point. So again, if the state bonds are paying interest, now you can understand the business model that the bank takes in whatever, $100 worth of gold coins, gives you notes saying upon demand, you can turn these notes in and get $100 in there. But so long as the community largely passes those notes from hand to hand and nobody turns it in, or very rarely, then the bank can take 90 of those gold ounces, buy government bonds yielding 6%, and the bankers now are earning that interest income. Because the community,
I should also note, and I know this is dragging, but just quickly, it's complicated. In a free banking era, a bank's, all the deposits it takes in, that's its liabilities, maybe 20 or 30% of that exists in the form of banknotes. The remainder exists in the form of deposits, which we still know today. So checking accounts and savings accounts. And the checking account liabilities, there might be a reserve requirement there, maybe 10, 20%. They have to hold gold in the vault as reserves against that. But the rest of that is not, there's no reserve or collateral requirement. So that's probably going to be the bulk of the money used to fund their lending activities. So you have to kind of have a view of the bank's, the full balance sheet. They take in deposits, checking accounts, savings accounts, and then they also have the ability to issue banknotes. And so there's some mix of different liabilities over there. And some are short-term banknotes would be current liabilities. They're payable whenever on demand right now. Same thing with checking accounts, although there's maybe a little bit of a delay in the processing of a check. Then there's different kinds of savings accounts, different maturities like CDs and so on. And then the bank takes that mix of funds that it collects from liabilities and then funds all of its lending activities. And then you could have kind of a structure of lending assets that matches maturity-wise, because this is one of the big critiques of fractional reserve banking in general, is that, well, they're maturity mismatching. They have current liabilities, which are payable today, and they're using that to fund long-term things like maybe 30-year mortgages.
Right.
And that is prospectively unstable, because if the liabilities come due, people want to redeem the liabilities, want to take their money out or exchange the banknotes for coin. And the bank says, well, we can't do it because it's a wonderful life phenomenon.
Right. Well, I don't have our money. Your money's in Joe's house. Yeah, I gave it to Sally.
And that is probably a bad idea, which is why I think single-purpose banks like S&Ls or building and loans, that's probably not a good banking model. And this is an entirely separate issue. That probably only exists because of kind of regulatory hassles. But in a free bank, you'd have a mix. You got diversified liabilities. And the market process is going to drive the bank to kind of optimize this decision. How much notes can we afford to issue? How much is safe? What's too risky? How much checking account liabilities? Part of it's based on what people want and what's safe. And then the bank says, how much loan should we make for consumer loans, for credit cards, car loans? How much should we do in business lending? How much of that should be unsecured? How strong of a collateral? And that's the business of banking. The responsibility of banking is to make those risk assessments. And the free banking people, I'll just kind of try to wrap this up. Free banking people say, We trust a market process, a profit and loss, and entrepreneurship and contract enforcement to work all that out, just like we do in the provision of any other product. And yeah, are there special things about money? Yeah, but it's not special enough to where we need the government to either intervene or oversee this, or in the case of like the most extreme people, and I think Eichengreen maybe falls in this column, they say that money is so special that the government has to provide the money and then make the ultimate determination about the supply. And this, of course, happens through central banking and all the regulations that are promulgated. And I see a lot of this blowback to stablecoins as the central bankers and their apologists and maybe the academics, they're scared of, oh, freedom is coming back, competition, a market process of discovering maybe different ways and more efficient ways to have money issued and paid and work around some of the older inefficient mechanisms. So it's an exciting thing if you're for innovation and free market and financial freedom. It's a scary thing if you're locked into the status quo of the government controlling everything through the central bank.
Right. So that's the thing. It's certainly not that Tyler or I or anybody else, Michael, isn't saying, oh, there should be a law that forces everyone to use Circle products from now on and they can't use anything else to pay people. No, like it's options. If you don't want to use it, if you think it's too risky, then don't use it. So we're just giving more options to people. And also too, you alluded to like the S&L crisis. The S&L crisis was not during the free banking era. That happened, smack dab, and when we had top-down regulations and everything, you know what I mean? So it's funny, a lot of these things, people point to banking panics or failures, or, the Great Depression or the Great Reset, things that happened clearly on the Fed/regulators' watch, and then say, well, it's a good thing we had them in place because imagine how bad the free market would have been. And it's like, well, okay, but... Okay, well, I know you have some material. Why don't we dive into some of that source material?
So that's a good segue because we can say, okay, well, speaking of what the free market would have done, and again, this is a quasi-free market. I'm acknowledging that. It said 1.5 years for free banking. But so even with the branching and the bond collateral requirements and these kind of strictures that states implemented, it still worked reasonably well. So can you bring up the chart? This is from Hugh Rockoff, a very famous paper in the free banking literature. It's called A Reexamination of the Free Banking Era from 1974. And he was, I think, one of the first people to really look at the data on this. And so there's a lot we could look at here, but this is pretty instructive, I think. Discounts on banknotes at Philadelphia, selected dates from 1845 to 1858. So this is kind of the meat of the free banking era. Right before the Civil War, I think he said 18 states had free banking, and it was a pretty mature system, and it was functioning pretty well in most of those states. And this is what Eichengreen was worried about. Well, if private entities are issuing these dollar-denominated currencies, well, how will we trust them? And maybe they won't be worth $1. Maybe their value will fall below $1. So that's what Hugh Rockoff is looking at here. And you can see here, well, the discount in terms of a percent, look at the top there, New York, it's never less than 1%, meaning it's the average New York free bank note is trading at worst at 99 cents in Philadelphia. Now, in New York, it's likely trading at $1 because in New York, you can easily walk into that bank, hammer that note down and say, give me the $10 in gold coin. In Philadelphia, the bank says, well, we've heard of this bank and we'd probably trust them, but if we wanted to redeem these notes for gold, we'd have to get a whole bunch of them, make it worth our trip, put them on a wagon, drive up to New York City, walk into that bank. So there's some transactions costs. So I would argue that a big part of this discount is just the transactions costs. Some of it is information. Some of it is like there's some uncertainty, there's some risk of accepting these notes. There's a very small risk that for whatever reason, that bank might not be able to pay. But part of it's just transactions costs. But you can see here, the top of the page, that these discounts are less than 1%. So in other words, you can receive bank notes from an out-of-state bank knowing that they're probably going to be worth at worst 99 cents. And, if the guy walks into your store or the guy you're doing business with is presenting you with out-of-state banknotes, you might say, well, I need to charge you a little bit of an upcharge. I need to tack on 1 or 2% because you're paying in these notes. And of course, the guy will understand, because they call them foreign notes, just from a distant bank.
I'm glad you made that clarification because, looking at this, you might say, oh, so it looks like Pennsylvania must have had the soundest, most trustworthy banks. But your point is, no, if you read the title of this, it's saying at Philadelphia. So these are all quoted.
That's just a geographical thing. That's just a transactions cost thing.
Yeah.
Pennsylvania, why were their notes not at a discount? In Delaware too, right across the river. Well, it's because you could easily take those notes over and hammer them and turn them into gold. Now you go down this, so you see most of these discounts are 1% or less. You go down to Mississippi, Illinois, you go down to Michigan at the bottom there. Michigan in 1845, fresh after the Wildcat episode in the late 1830s, yeah, they're trading at a massive discount. They're kind of worthless paper. That's because Michigan, and we can get into this if we want, due to its regulatory, let's say, foolish regulatory structure, basically opened the door for fraudulent bank operators. Then once that was realized, that kind of died out quickly because the public learned its lesson. And then Michigan rewrote its laws later on. And you can see Michigan 1856, 57, those discounts have gone down. Now you see 1857 there, a lot of the notes from whatever state are trading at 5, 10, 20% discounts. Well, that's because there's a financial panic going on, the Panic of 1857. By the way, I was really surprised that Eichengreen wanted to say that free banking was an unstable episode, and he pegged all of that on Wildcat banks, which we can talk about more in a minute, which was really a sideshow. It was really kind of literally on the periphery, on the frontier. It was not the financial centers. It was not common, actually. And the real argument he probably should have made was that, well, we had this big financial panic of 1857 during free banking. But maybe it's because if he knows about the scholarship of the Panic of 1857, it doesn't hinge on free banking per se. It hinges on some, shocks to the system, let's say, that caused a credit crisis. And you'll have the same kind of thing occurring later on, even with deposit insurance, even with the Fed, even with lender of last resort, even with all these mechanisms that the status quo people, the mainstream academics say we have to make banking safe. This is one of my critiques against this kind of thinking. So Eichengreen says, we can't have free banking. We can't have stablecoins. We can't have free banking. It's unstable and there's wildcats. Okay, so let's have a Federal Reserve lender of last resort. That fixes it, right? When we get the 1930s banking crisis, we get the S&L crisis with the Fed and deposit insurance. We get the 1970s great inflation. So, well, that doesn't really fix it. And that doesn't even take away financial crisis. In fact, the thing it might do is instead of kind of having small, localized, recurring crises or let's say runs or challenges to banks that are ultimately disciplinary mechanisms, it just concentrates and makes some big blow-ups like we had in 07, 08. So that's an argument that the free market people...
Right. And on that, folks, I'll link on the show notes to this episode. At Infineo here, I did a blog post recently where I was just summarizing, because Tyler, I recently did a zero hedge debate against David Beckworth about should we get rid of the Fed. And that's one of the points, is that it's not just anecdotal, like, oh yeah, the Great Depression and Great Reset, like empirically using economic deviation from trend growth and all that kind of stuff, standard deviations, blah, blah, blah. It's hands down, macroeconomic stability was higher in the pre-Fed era than in the post-Fed era.
Yeah, and there's that famous paper I'm sure you cited from Selgin White Lestrade.
Right, yeah, that's what I relied on. Yeah, it showed the table they had from that. So again, it's just ironic that we're saying, oh my gosh, we can't go back to those horrible days when it was, the gates were open, the floodgates were open, anything goes. And it's like, even just using standard objective economic history, the economy was more stable back then. So yes, things did happen. It wasn't perfect, but it wasn't the Great Depression. And so say what you will, oh yeah, well, the Fed learned their lesson and they thought they had it all under control. And then, Great Recession happens too. So
let me get into this issue of the wildcats. So Rockoff in his paper really goes into detail about why wildcat banking was able to occur. All right, so Michigan, shamefully for me, was kind of the epicenter of wildcat banking, although I think Indiana, Minnesota, several frontier states. And in the late 1830s, there wasn't a lot going on in Michigan. So it's not like it was systemically important. Of course, if a local bank ripped off people, that's sad, but that's people try to rip people off. We need a market. That's what the market's good for, right? To expose frauds and shut them down early. And I think that's my reading on this, is that's what happened. So the regulatory structure was flawed, but it nonetheless it kind of got the door closed on it through a market mechanism. So Rockoff says about the Michigan free banking wildcat experience. He says in Michigan in 1837, mortgages on land were eligible for banknote collateral, and they were accepted at par. It was thus possible to create a mortgage on a worthless piece of property, have it certified as being valuable by some friends, and then transfer it to a wildcat bank in exchange for a massive banknotes. This seems to be the process by which many of the Michigan wildcats issued currency. Others were simply frauds which operated in violation of the free banking law. So the regulation, which allowed like basically any kind of bond, so you could deposit government bonds as the collateral for the notes, or any mortgage that's basically endorsed by somebody. So it's like, I have a piece of property in northern Michigan, and let's say it's worth $200,000. But let's say you issue me a mortgage for $1 million, and then we have it certified. We go and bribe the county clerk or whatever and have it recorded. And then I walk into the bank and I've got $1 million mortgage here. So that's collateralized a loan. And they say, okay, because we're all in cahoots. And then we take $1 million in notes and then we try to go and spend them. Now, of course, the rule in a market is caveat emptor. And I think this is underreported, and Rockoff kind of gets to this. Like, why should I take notes from the Bank of Bob? I've never heard of you before. Oh, well, maybe because I assume that you're a registered bank and I trust the state that you've deposited collateral against the notes. And at the very beginning of the process, maybe that's what happened. So, okay, well, you're a registered bank and the government says that you've collateralized these notes, so I'll take them, even though the whole thing is a total fraud. And the moment a chunk of those notes comes back for payment, they realize you have no gold in the vaults and you're done for. So it gets shut down pretty quick. So maybe you ripped off some kind of unsuspecting suckers, let's say, but it's not going to persist, and it's not like a permanent feature of the system. So let me go on with Rockoff here if I can. He says further down, it says, it is interesting to note that some 20 years after her first disastrous experiment with free banking, Michigan passed a second free banking law. The eligibility requirements were far more strictly drawn than for the first. The monetary statistics of the resulting banking system clearly show that there was no wildcat banking. Michigan's two free banking laws were not part of a controlled experiment. Nevertheless, the contrasting experiences under the two laws appears to be strong evidence that the source of wildcat banking was to be found in the provisions of the free banking law rather than in something else, for example, the conditions of frontier life. So in other words, it was just kind of foolishly written regulations that were easily adjusted regarding the banknote collateral. And then once they did that, that snuffed out wildcat banking entirely. He goes on, I want to just
if I could just stop you, and even there, like you're saying, it's because some people might hear that and say, okay, so you guys are admitting we do need the strong hand of government, and if they regulate too lightly. But I think part of what you're saying is people may have originally thought, oh, because this actually is regulated, it's not literally laissez-faire. There were charters and blah, 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 and state legislation.
Right. So you can make an argument that we'd be better off with no regulation other than contract law, which requires the bank to pay its liabilities, because then the initial trust level would have been really low and banks would have really had to establish trust through maybe smaller transactions and repeated dealings showing that they were good to redeem the notes and make good on their liabilities and so on. So I would probably fall into that camp. I'm more of a libertarian, but even if we want to concede things to the regulation crowd, say, well, the regulation has to be smart enough to not be easily gamed. And but of course, we see that again and again and again in banking and finance.
But even with that table, you showed, I think, again, this is all, it depends, if you're absolutely committed to being an interventionist, you're going to see what you want to see. But someone might have said, like you showed those Michigan, that first tape, the number was really big. But I think that's kind of the point, that suppose the Michigan regulators didn't change the rules and they say, yeah, go ahead, you can cook up some bogus mortgage number with your buddies and the banks can issue note. Well, pretty soon everyone catches on to that. And so nobody's going to, those discount rates would have gone up to 99.9%. So that would have ended that practice. In other words, if they didn't change the regulation, then that would have stopped being a siphon of wealth.
And what do we call that, Bob? We call that a market discipline, right? We call that the profit and loss mechanism or the competitive mechanism, that's the regulator I want. And that why I'm a big fan of free banking is because ultimately in a more pure free banking system, the regulator is the market process rather than a government maybe just guessing. Of course, we got a knowledge problem there. How do they know, what the reserve requirement should be, what the interest rate should be, what kind of capital, what kind of collateral should be allowable? That's assuming that the regulators are kind of above board. The regulators might also be corrupt or self-interested. And of course, we have public choice arguments too. So let me give one more quote from Rockoff here, because I think this might be more instructive than the numbers. He says the experience under wildcat banking was quite varied. In Michigan, the notes in many cases, although not all, became worthless. If the estimate in Table 2 were correct, it's talking about the total losses there, the total volume of wildcat money would have been amounted to about 11% of the annual income of Michigan in 1840. And that's okay, that's a pretty big number. But he goes on to say, however, while the bank commissioners refer to 1 million of losses for Michigan note holders as a low estimate, it is likely that they had in mind the face value of the wildcat issues. Even from the first, many of these notes may have borne heavy discounts, for it appears that the public caught on rather quickly to the condition of the wildcat banks. The bank commissioners had already closed a number of banks and had officially reported their findings in March of 1838. Disenchantment was sufficiently widespread by April of 1838 to induce the legislature to suspend the free banking law. Thus, the condition of the wildcats was surely common knowledge sometime early in 1838. Since few of the wildcats were organized until after the general suspension of specie payments in June of 1837, the lifespan of the typical Michigan wildcat bank was 6 months at the most. So in other words, this is like a flash in the pan. This was a fraud, or at best, a severely flawed regulatory outcome, and it was snuffed out, and then it was restructured. But in other states where it was done more sensibly, it was pretty rugged. And so what Eichengreen is doing here, and this is like, I think this is embarrassing for a professional economist, not looking at this literature at all, and then just totally straw manning the system because it doesn't align with his preferred view of what our monetary regime should look like. Now, I'm okay with Eichengreen having a different point of view, but let's have a debate based on the actual data here, and not just smear tactics, not just scary stories that are really irrelevant. So that's the most bothersome thing I find about the Eichengreen piece. But we can maybe also kind of talk about the stablecoins themselves, and we've talked mostly about free banking, but maybe we want to get into stablecoins themselves a little bit and how they are and are not representative of free banking.
Well, I do want to wrap up with that, but just to make sure people caught that, because that was an important thing. Because the quote you read from Rockoff, he was alluding to that statistic that Eichengreen had used about, this is the amount that Michigan residents lost, which is, half of the state income or something. If I understood him, he was saying, that would be if you took the notes at face value.
Yeah.
And,
well, and Eichengreen also says one estimate places losses of Michigan residents from discounted worthless banknotes. No citation. That's cherry picking. Come on. He ought to know better than that.
But the point that I think Rockoff was making was to say that it would have assumed that when the person who originally got that note paid full value for it, and then, then later it was, whereas if there was already a discount in place, then a lot of those notes might have said $100 on the face, but maybe the original purchaser even only paid $50 for it.
Yeah.
And then if the thing only paid $25, they would have said, that guy lost $75 on that, when really he only lost $25.
Now, I would encourage the viewers to read the entire Rockoff paper. It's pretty accessible. There is a little bit of econometrics in there. He's trying to estimate he's trying to estimate a loss function based on private banknote circulation. But I think he's very fair. He's not some kind of necessarily some free banking apologist. I think he's looking at this as an honest scholar. I want to look at the data and assess it. And maybe he's got, I don't know what his priors are. Maybe he's a libertarian, free market fundamentalist like us. And he's like, boy, I want to prove that free banking worked. But even if that's the case, he engages with the data in a very kind of robust manner. So it's a respectable piece of scholarship. And it demonstrates that these claims of wildcat bank are massively overblown.
Yeah.
The system worked pretty well. Now, that's not a pure system. So, of course, free banking advocates like me would say, imagine how much better it might have worked if it were more pure free banking. But it is what it is. Stablecoins are not pure free banking, but they're kind of an element of free banking layered on top of our existing system. And my sensibility here is that if any kind of step back towards a more free market, a more competitive, a more open, let's say, market in finance, it's probably a good step. And given that we're kind of stuck with the regulatory environment, my take, and I'd be interested to hear yours, Bob, is that the Genius Act is probably pretty conservative and pretty safe in its regulatory structure, because it's requiring 100% quote backing. We mentioned this earlier on stablecoin issues. And of course, that backing can take the form of Treasury securities or Federal Reserve notes or dollar bank deposits, right?
Right. Or
That's what I got. By the way, I learned a lot from your episode with, was it Nikki
Sanders?
Sanders. Yeah, Nikki Sanders. That was a really good, informative episode.
Well, thank you. Yeah. And then also, I think it technically also allows like money market funds if they're backed by those.
Money market funds would almost
aforementioned
most commonly
components.
be treasury bills, right?
Right.
Yeah.
So,
or I guess maybe short-term commercial paper. Yeah.
No, but I'm saying, no, it's the money market funds can only be the ones of the assets they mentioned.
Treasury bill fund.
So that's what they're saying. So it's kind of the same, reduces of the same thing. Yeah, that's, and I, with the clock here, I do have to wrap up here, Tyler. But yes, I agree. And that's what I've said. Like, given that they do have to put in some regulation on stable coins, and in the current environment, they have to do that, right? Because people aren't going to invest a bunch and go ahead and build all the technology and infrastructure and get clients and so on. If they're worried they're going to get the rug pulled out from under them, that, yeah, this was very reassuring to most of the people I've talked to, in this space, to get some regulatory certainty. And that, yeah, as far as it went, it was very conservative. I think probably you're right, is the right word. I just point out things like the irony that it's sort of like, oh yeah, we got to insist on 100% reserves to make sure that this market is stable. And yet the regular commercial banks don't have to have 100% reserves, even defining reserves the way, they're talking about. It's not like Citibank is holding,
did
a bunch
Barry
of treasuries.
Eichengreen have anything to say when the Fed cut reserve requirements on transactions deposits to zero? Was that in
2020? They did it right during the COVID stuff. Yeah. I don't remember that happening. I haven't gone and looked.
Of course, he knows that the FDIC is going to cover the vast majority of depositors, and then the Fed will make good for any losses beyond $250,000 cap. So that's what the presumption of the backstop of the Fed and the regulatory regime. And maybe, to give Eichengreen the point here, stablecoins exist outside of the bank regulatory regime. So they're not eligible for relief from the FDIC or the Fed. And I think you and I might say, well, good, because that makes the that kind of pulls the moral hazard issue down, and it makes it more of a caveat emptor environment. Like, whose stablecoins should I accept? Yeah. Well, I would probably accept stablecoins from Amazon or Walmart, because those are big, reputable companies, and they don't want to burn reputational capital by having some kind of stablecoin scandal.
Well, exactly.
The bank of Bob that just opens up, I come take my stablecoins. Like, I don't know. I don't know you. I don't trust you. I bought some PayPal stablecoins the other day just to say I could own some. I think it was only $50. Like, PayPal, I've been using them for 25 years, I think. I trust them, and they're reliable. They've proven themselves to be reputable financial actor. So sure, I'll take their stable coins. And then, of course, I know you've talked about this a lot, but the benefits of stable coins are very exciting. Earlier on, you said nobody's going to be forced to use them, and a lot of people will never even come into contact or have any kind of knowledge of stable coins, because they're going to be happy with their bank payment media, writing checks or swiping debit cards or whatever. But I just thought of a couple examples. The little essay I wrote said that stable coins are going to be especially attractive to people sending money abroad or doing cross-border transactions or dealing with the unbanked. But I just thought of a couple use cases for myself. I donate regularly to my church, and I do that with a paper check, because if I go online to do a bank transfer, they ask me to eat, I think it's a 6% transactions fee. And part of that would be the bank interchange fee. And then part of that's another fee tacked on by that payment processor. And I say, well, forget that. I want all this money going to fund my church or whatever charity I want to support. So I still do that with a paper check to avoid that fee. But that's a hassle, right? And it takes time to process and everything. Well, maybe in the future, I'll be doing that with stable coins. Maybe in the future, stable coins are going to be an end run around the higher costs of the bank network. And you've talked about this. And that's going to be a benefit for potentially everybody. So reducing these transactions costs alone is going to be a huge benefit of stable coins.
Yes, I agree. And we have to wrap up there, because I have another thing I got to jump on here, Tyler. So folks, my guest has been Tyler Watts. Tyler, thanks so much. We're going to put links, folks, to all the articles and things that we've been referencing. So Tyler, thanks for everything you've been doing and taking time here to explain how free banking works.
Yeah, happy to be here, Bob. Thanks a lot for having me.
Thanks everybody for tuning in. We'll see you next time.